Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 135th CP program organized by AASB of ICI for this council year. As we all are aware that we have taken into consideration all these sectors, today we are going to cover forex transactions as well as the professional skepticism. So we are going to cover two very important topics for our chartered accountant fraternity: professional skepticism and key considerations in audit of forex transaction. And in order to tackle these two very important sectors, we are having with us our today's keynote speaker, CA NC Hegde ji, and our guest speaker, CA Lokesh Gupta ji. So on behalf of AASB of ICI, I extend my warm welcome to both the learned speaker. Welcome to you, sir. Welcome, sir. I also welcome all the participants of today's webinar. We are having with us two young moderators, C. Ajay Goyal ji and C. Mansi Kandpal ji. So I also welcome both the moderators in today's webinar. Honorable Chairman sir and Vice Chairman sir both are stuck up in another meeting. So I'm taking this liberty to start the today's webinar. I request Ajay Goyal ji to please start the proceedings of this today's webinar. Over to you, Ajay ji, please.
Thank you so much, sir, for the handover. So very good evening, everyone, and a warm welcome to the entire fraternity in the today's 135th CPE program for this council year. My name is CA Ajay Goel, and I'm the member of this prestigious institute from the past 6 months. First of all, I would like to thank CA Sanjeev Singhal, sir, Chairman AASB of ICAI, CA Vishal Doshi, sir, Vice Chairman AASB of ICAI, and Anil, sir, for organizing the series of informative webinars where the experienced professionals come together to guide and advise the other professionals so that we can all ensure and deliver the high quality audits. And a very big thanks to the entire panel for providing me the opportunity to be the moderator for today's session. So today we have two eminent speakers with us who will be sharing their professional insights, key challenges, as well as the opportunities on the topic, the professional skepticism and the key considerations in the audit of forex transactions. It is one of the hot topics nowadays and is most important for every audit. As while auditing the forex transactions, the professional skepticism and the key consideration are crucial to ensure the accuracy and integrity of the financial reporting. CA Nancy Hegde sir is the partner with Deloitte for more than 25 years in the tax and regulatory side. He has been the member of the Central Council of the ICAI for the 2 terms from 2015 to 2021, and he was a member of the several committees during that period as well. Now, I would like to invite my co-moderator, CA Mansi Kandpal, to introduce our esteemed speaker, CA Lokesh Gupta sir, and take the proceedings further. Over to you, Mansi.
Thank you so much, Ajay. Good evening, everyone present. First, I would like to thank CA Sanjeev Singhal, Chairman AASB of ICAI, CA Vishal Doshi, Vice Chairman AASB of ICAI, for giving me this opportunity to be a moderator in the session. And it's my honor to introduce CA Lokesh Gupta sir. He's a partner at Mrs. Shyam S. Gupta and Company. Also, he holds a LLB degree from DU, DISA, FAFD, and concurrent audit course certification from ICAI. With more than 20 years of experience in statutory, concurrent, and internal bank audits, Lokesh sir has also contributed to numerous professional seminars and trainings on banking sector, FEMA, FCRA, and other areas related to Forex. Also, he has the experience of conducting statutory and internal audits of large number of units in public and private space, along with providing consultancy for FEMA and international tax to diverse client base. Welcome, sir. Now, I would like to invite CA NC Hegde sir to kindly start the session. Over to you, sir.
Thank you, Mansi and Ajay, for that introduction. And good evening, viewers. First of all, let me thank Sanjeev Singhal, our chairman of the Auditing Assurance Standard Board, and Vishal Doshi, who's the vice chairman, for having given me this opportunity to express a few words on, or a few thoughts on professional skepticism. Let me also confess that, I'm not really an audit partner by background. I'm more of a tax professional and a lot like Lokesh, maybe a little bit of international tax, FEMA, etc. Though I focus more on the exchange control regulations as opposed to Lokesh's expertise on Forex audits, etc. But of course, professional skepticism is something that is required both in audit and in tax, and in a very recent order of NAFRA, we came across NAFRA actually looking at a certificate issued by by chartered accountant on a tax topic, which is 80JJAA, and commented on the fact that he probably did not exercise enough professional skepticism in carrying out his certification duties, and therefore professional skepticism something which cuts across, I would say, any part of a chartered accountant as and when he's doing an attest function as such. Thanks to Mr. Anil as well, Anil Lal, for having me on this program and giving me this opportunity. As I mentioned, professional skepticism is something not unique to audit, not unique to tax. It cuts across, various aspects and probably functions of a chartered accountant. The word skepticism itself means, I would say what you would call shak karna or whatever in English. It would mean that suspecting something or refusing to believe, having a non-believing attitude, not probably going by blind faith or blind application of whatever one has been asked to do, but looking at something with a disbelieving kind of an attitude. So that is what is the normal terminology or normal meaning of the term skepticism. We have seen that, right from ancient times, skepticism is something that has been very inherent in what we have been taught by our gurus, by our seniors and others, and that is very evident when we have the proverb in English which says that don't judge a book by its cover. Basically, just because the cover is fancy, flashy, don't expect that the book is very good. It may have very different technical content. Similarly, if you would have heard Shakespeare say, he said, all that glitters is not gold. Means just because something is glittering doesn't mean that it is gold. So exercise skepticism, exercise your skepticism to make a decision on any particular subject. Don't be fooled just because something either looks good or something appears good by its cover as such. Closer home, even in Hindi, we have different proverbs which kind of indicate how we have over the years looked at this area of skepticism, and how, as I said, elders have always asked us to be careful. And there's a very famous, I would say, poem where, or it could have been probably a doha of Rahim the Great, who was one of the 9 gems in Akbar's court, when he said that naman naman mein farak hai, cheetah, chor और kaman. In the sense, वो बोलता है चीता जब आपके तरफ नमन करता है, बट वो नमन से आप डरना, बिकॉज उसके बाद वो छलांग लगाता है. So there again, there is this entire appeal that one needs to be skeptical when one is looking at a particular situation. So when you then come to a role of an auditor, obviously when you are doing the audit of a public entity or even of a private entity, and when the financial statements of that entity are going to be used by a whole set of users as well as stakeholders, I think it is very critical for a professional to exercise what is called as professional skepticism. So, as defined by the closest definition of term professional skepticism is in our standards of auditing, and SA 200, which talks of professional skepticism, and it says professional skepticism is an attitude which includes a questioning mind and a critical assessment of audit evidence. So this entire emphasis there on the professional skepticism definition, as we can see, is something that has to be a questioning mind. Don't take things for granted. Keep questioning and critically assess the audit evidence in order to come to the truth as such. Similarly, SA 200 again then advises us that an auditor should perform an audit with professional skepticism, recognizing that there may be circumstances which may lead which may arise and that may cause the financial statements to be materially misstated. So be on the watch out, be on the lookout, because and exercise professional skepticism, because there could be circumstances which may so turn out that your financial statements may be misstated. So these are some of the definitions and the approach as far as the audit standards concerned. There are many more audit standards which deal with professional skepticism. In relation to the overall guidance, as far as fraud is concerned, NAFRA had come out with a paper which highlighted to the auditor that it is duty to report fraud. And in relation to that duty to report fraud under Section 143(12) of the Act, and then report it to the central government as well as to the audit and the board committee, there was a an emphasis on the fact that the auditor must look at evidence and must look at things with a professional skepticism and not just go by whatever the management presents him. There was also this final reference to professional skepticism in that particular circular where there was a mention that even if the management comes out with some legal opinion, etc., don't just go by that legal opinion. Trust your gut and look at the legal opinion. And if only if you are convinced with that legal opinion and the facts, etc., accept it, otherwise not, please use your professional skepticism. So professional skepticism has been referred very often. Now, what are some instances that could lead you to believe exercise your professional skepticism and which may indicate that there are some red flags in an audit? And that again is something which is highlighted by your standards on auditing, the SA 200. Some of them which are referred to are audit evidence that contradicts other audit evidence, means essentially you don't find that things are in sync. One audit evidence doesn't really lead to other audits evidence being in sync, and therefore probe greater or probe more, I think, is the message. Then there could be information that brings into question reliability of certain documents and responses to inquiries which are to be used as audit evidence. So whenever there is some information that makes you suspect that, look, whatever was the response and whatever was the document that was provided to you doesn't seem to really tie up, then, and that is to be used as audit evidence, then definitely probe deeper, probe as such. Then most important, as I mentioned, and where now auditor has a specific duty under the Companies Act under 143, is conditions that may indicate possible fraud. That is clearly a red flag as far as an auditor is concerned, and that is something that you will need to look at. And circumstances that may need for audit procedures in addition to those required by standards on auditing. So there could be circumstances that you may come with your gut feel, you may feel that I will need a greater emphasis on certain audit procedures, not only those which are laid down by the certain standard as such. So what would you conclude by all the definitions? And I think whatever has been, as I highlighted in terms of red flags, that an auditor in his nature of the audit, in the way that he goes about an audit, does require an understanding of the various control activities related to the significant account balances, which auditor may find relevant in his risk assessment process. So in this, again, in several orders of the NAFRA, there is a reference to the professional skepticism that an auditor should have exercised in relation to very large account balances, very large loans out of the total portfolio, maybe 80-90% of the loans being given to a particular entity, and there being no professional skepticism exercise. In fact, in certain orders of the NAFRA that I came across, professional skepticism has been mentioned nearly 14-15 times, showing the kind of emphasis that the regulator is now putting on this entire aspect of professional skepticism and how an auditor has to exercise that in order to ensure that public users or people who now rely so much on audit of the financial statements really rely on the statements as such. Very often you get into a tendency where you think, okay, the management is really honest and there is a lot of integrity, there's no reason to suspect. Again, there I think an important point to note or emphasize is the very fact that the belief that the management and there is trust and those who are charged with the governance are generally honest and integrity does not really mean that the auditor is relieved of his duties to 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 kind of taking out the skeptical cap. You have to maintain and keep wearing that skeptical cap at all times is what we have been advised in our entire auditing standards and the general approach on auditing. And I think the very famous statement that I think that is often used is trust management, but verify. So don't give up on your verification, on your procedures, just because you believe that the management or whatever and those charged with governance are, people with integrity, with the background, etc. Yes, certainly trust them, but at the same time, don't be relieved of your duty. Please verify the documents as and when which is required. As I mentioned earlier, executing an audit, and effectively high audit, consists of exercising professional skepticism at each level and with a due care as such, right? So as what would be our role as an auditor? And these are some of the aspects one has to look at. We already spoke about a questioning mind, which was there in the very definition itself, that uh, please keep on questioning any items and especially assumptions and estimates that have been made by management, especially because there may be no guidance, etc. But just because an estimate, you can't just rely on an estimate or a judgment or whatever which has been given to you. Please question that, see how it makes sense to you and whether it appeals to your sense of logic. Then critically assess audit evidence. If there is audit evidence, critically assess it throughout the course of an audit to see that whether it makes sense and whether it ties up, as we saw in the earlier one, which was a red flag, was if there's one evidence which is contrary to the other audit evidence, then that itself is a signal that you need to probe in much greater into the entire audit process and into the systems as such. Identify and assess the risk of material misstatement. This is one which I think I would like to emphasize the most, that wherever you believe in terms of your auditing standards, you are required to look at the possibilities of there being a material misstatement. And therefore, if you get any kind of doubt or suspicion that there could be something, then it is our duty not only to identify, but to also assess the risk of the material misstatement. And that is where professional skepticism comes in very handy. And finally, the fraud risks, which I also already spoke about, our duty to, under the Companies Act, now carved out in the Act under 143(12), where there is a responsibility to report. And even if that responsibility also covers an aspect of that there was already an audit which was deducted, not necessarily by the auditor, but someone else, then you have to report on it under as a part of section 143(12) as such. So having read and heard about what audit and professional skepticism all is about, now I think it is very important to ensure that we document that one has gone through this entire process of having been skeptic while auditing and putting that as a part of documentation, because otherwise how would anybody know that you have made those necessary inquiries or you have displayed that questioning mind that an auditor was required to display. So documentation becomes very important, because that should demonstrate the critical assessment of audit evidence that you have looked at. What did you look? How did you inquire? How did you satisfy yourself? Is a very important aspect. And as I mentioned earlier, particularly important in cases of documentation, wherever there is a management estimate that was required or a judgment that was made by management, or if it was a one-time non-recurring event, which has a very significant influence on the material on the financial statements of the company. In such a case, I think it becomes very important, especially to document what you have inquired, how you were satisfied with the responses and with the evidence that was so declared. As I mentioned, don't go only by the management's response and management's estimates and management's assessment. Do try and see wherever possible. If you could then see whether it satisfies you, use an expert wherever possible. If you are not completely satisfied and if you do not have technical knowledge on the subject, please use an expert wherever required, but just don't go by whatever management is saying. Why do we come across instances where there is a failure to apply professional skepticism? One and the most common reason for that could be that we are very concerned about the client satisfaction and the rates of client satisfaction these days. Audit, like any other service, is a service to a client, and we are very concerned of how client would view us in terms of how we perform the audit. If we are too critical in approach, if we suspect everything, then we are necessarily likely to be grilled on the basis that you're like a watchdog or a bloodhound, and these are the kind of tirades that are going to be put towards us, and therefore it is very important, however, to ensure that in spite of these high client satisfaction rates that we try and get, and sometimes we obviously also have a client relationship to take care of, and nobody wants to jeopardize that client relationship. So that is where then professional skepticism often becomes a victim, because of the fact that one wants to have a decent client relationship, the relationship which keeps on flowering from year to year, and to obtain high client satisfaction rates. Therefore, I think it becomes extremely important in the context of professional skepticism to ensure the kind of independence that we have from an auditor, and both professional skepticism and independence are very, very strongly linked, I would say. Then failure to obtain audit evidence sufficient to support the conclusions, that also leads to professional skepticism not being exercised. We spoke about contradictory evidence. Obviously, if you have not considered, and if there's a failure to have contradictory evidence, then that could often lead to you're not uh, mm, uh, exercising professional skepticism, or a failure of professional skepticism. And finally, there could be a failure of professional skepticism because you may just have gone ahead and accepted or defended the management assumptions and estimates instead of challenging them. So just because you got a particular management estimate or an assumption, you took that for granted without challenging them. That could also be a failure of yours in order to exercise professional skepticism. Now, I would like, before I end, to kind of highlight a particular para. As I mentioned in NAFRA, more and more professional skepticism is something that is being really looked at, and every order of NAFRA talks about professional skepticism or the absence of the auditor to apply professional skepticism. And now with your permission, I will read a particular paragraph from an order of NAFRA just to highlight how NAFRA has looked at professional skepticism in such great detail. And I quote the order of NAFRA. The auditors were required to exercise professional skepticism and judgment and evaluate the business rationale of these transactions. As per paragraph 5, and my idea of reading this is also to give you a hint of the different auditing standards that NAFRA is looking at, with a view to also ensure that you probably pay attention to them. As per paragraph 5 of SA 315, they were required to perform risk assessment procedures to provide a basis for the identification and assessment of risks of material misstatement at the financial statements and assertion levels. As per paragraph 5 of SA 330, they were required to respond to the identified risk of material misstatement. SA 240 prescribes auditors' responsibilities relating to fraud in audit of financial statements. Paragraph 10 of SA 240 provides that the objectives of the auditor are to identify and assess the risk of material misstatement in the financial statement due to fraud obtain audit evidence, and respond to identified or suspected risk. Paragraph 12 of SA 240 requires the auditor to maintain professional skepticism, recognizing the possibility of existence of material misstatement due to fraud. Paragraph 32C of SA 240 further requires an auditor to evaluate the business rationale or lack thereof of the significant transactions that are outside the normal course of business or otherwise appear unusual, and evaluate whether such transactions may have been entered into to engage in fraudulent financial reporting or to conceal misappropriation of funds. This in particular is very important because, as we said, look at those non-recurring events, look at those other transactions which are outside the normal course of business, but which probably have been entered into with a view to conceal or misappropriation of funds or to engage in fraudulent financial reporting. So this is something which time and again the NAFRA has kind of highlighted. Finally, as per paragraph 11 of SA 550, they are required to perform audit procedures and related activities to identify the risk of material misstatements associated with related party relationships. This is another area which you find in so many orders of the NAFRA, where they are looking at, audit procedures not being performed, professional skepticism not being exercised just because it was probably routed to a party which was a related party, but not directly, but through an indirect chain of kind of lendings or borrowings and things like that, which concealed, which were more in form, but in substance, it actually went to the related party. And that is where NAFRA is saying, where was your professional skepticism? Why didn't you look at how an entity which had no connection with the business, no connection with the ultimate money was routed to them, which they probably lacked even business rationale. And finally, it ended up with a related party as such. So as you can see, NAFRA very, very concerned about professional skepticism. And therefore, I think finally, I would like to conclude by saying what is the key takeaway? Key takeaway is that whenever you're doing an audit, put your personal feelings aside. And as I mentioned, keep your hat off or cap of professional skepticism on. Management may be very honest. There may be a lot of integrity both there and within governance. But do remember that professional skepticism exercise is a must. Doesn't mean that you need to be very rude and rough and go about your audit as an investigator or as the enforcement directorate or any other authority would be. But at the same time, keep your professional skepticism hat in on always, because as you know, just like a saw and a carpenter and a hammer is an essential element of that particular trade. Similarly, for an auditor, professional skepticism is extremely important and an extremely important element as such. Stay professional, stick to the facts. No need of making a hue and cry around whatever. If you have stumbled onto the trail of something, stay professional, stick to the facts, and try and require professional and factual responses to whatever you have kind of uncovered, if there is uncovered. This is all the more important, professional skepticism, all the more important because the entire investor public actually relies on us and relies on the financial statements. And it is very important to give them that confidence. The auditor is doing his part of trying and seeing that there is fraud, identifying fraud, reporting that fraud, looking at things with a skepticism and not siding with the management and believing their assumptions and estimates. And therefore, to conclude, the need for professional skepticism cannot be overemphasized. It is, as I said, a very, very essential tool of the auditor. Thank you. With that, over to you, Mansi.
Thank you so much, sir, for such an insightful session. And now I would like CA Lokesh Gupta, sir, to kindly take forward the session.
Thank you, Mansi and Ajay. And first of all, my thanks to AASB and the chairman, Sanjeev ji, for inviting me here to share my views on what I found generally find a very important topic, and an area where generally, because I've been involved with a lot of tradings to other fellow chartered accountants on the area of forex, that generally what I've seen is there is generally a slight lack of understanding to the intricacies of the area, and therefore I felt that it's a very important area to actually understand. Uh, I have shared a lot of things are there. I've tried to share whatever I felt was very important when we are looking at any audit per se, where forex transactions are involved. Uh, I was listening to Hegre's very wonderful deliberation on the auditing aspect, and I think a very important thing which all of us as auditors should remember. So carrying on with that, let me share my presentation. Ajay, if you can confirm it, is it visible?
Yes, so it is.
Great. So basically, when we look at the key considerations, so I think the most I've tried to basically divide it into the regulatory landscape, which is basically comprising of the FEMA. So when we talk about India, FEMA being the governing act. So in case you are touching upon foreign exchange, any aspect of where you're doing imports, export, etc., you're touching on one of the other aspects of FEMA. So that is, of course, the most important regulation when it comes to the forex considerations. Then there would be the GFT guidelines that would be more important when it comes to basically the import-export guidelines, basically. Then we will have the income tax act, so the withholding tax, and of course the equalization provisions, which are there. And there have been changes like there has been uh, uh, area of significant economic presence, which we'll talk about in short. And then, of course, the goods and services tax, GST, could have its own implications when it comes to the foreign exchange transactions. The second area which I thought we should touch upon was basically the accounting standards, which are applicable in case we are doing a foreign exchange transactions. We'll touch upon some very important areas there. Then ICDA Section 43 and 43AA of the Income Tax Act there. So basically in relation to the recording of the transactions in the books of account. And then, of course, the verification of transactions and then arriving at an audit opinion. So starting off, I think what has changed over the years is that we are getting more global. Every economy in the world is getting more global. We are also, as a country, not far behind. Uh, Maybe 20 years down the line, I did my CA 98. So at that point of time, we had very few clients who were basically into even imports and exports. Now we have a number of clients who are not only into imports and exports, but are looking at setting up offices abroad, setting up companies abroad, or they are actually getting investment from abroad. So they are doing some kind of joint venture where there is a foreign partner. They are looking at getting technology from abroad, or they are getting some kind of a license from abroad, or there are a lot of transactions which are happening in which these forex considerations have started playing a very important role, and we have to keep pace. So another thing which I have learned over the years is that when we did CA actually on the lighter side, so everybody told us that once you complete your CA, you have to work hard, you have to study, and then you complete your CA, and then the life would be easy. But frankly, it has not been that easy. So the studies does not stop in our profession. So we have to keep on studying. We have to keep on updating ourselves. So this is, I must congratulate our institute for organizing so much seminars where we can actually share these knowledges. And because the experiences are unique to everyone, and these experiences actually help us learn a lot more than only reading the books actually. So moving ahead with that, now I'll touch on some of the important aspects of FEMA. Now, when we look at FEMA, basically, now FEMA per se, if you look at the act is very small. Yeah, it may be running into only 20, 25 pages. But frankly, the provisions are very elaborate, very detailed, and a lot of things are not actually given in the public domain. They are actually shared between the banks, the authorized dealers, and the RBI. which of course, when we deal with banks or we deal with RBI, we suddenly come to know that these are also the guidelines which needs to be complied with. So the act, then the rules regulation issued under FEMA becomes very important for anybody who are looking into getting into the forex. And then, of course, there are master directions and the notification issued by the Reserve Bank of India, which actually help us in explaining the provisions of the Foreign Exchange Management Act and the rules and regulation issued under it. Then there will be circulars issued by DGFT. There will be FIDI. FIDI is basically Foreign Exchange Dealers Association of India. So it's basically a body which is actually comprising of all your banks, which is dealing into foreign exchange. So basically, they are trying to standardized practices and would definitely have an impact on our audit also. And then we have ICC. ICC is basically International Chamber of Commerce, where basically they are actually trying to standardize practices across continents, across financial institutions in two different countries, two different continents. Because when we talk about foreign trade, we are talking about financial institutions sitting in two different countries, situated in two different countries, two different continents. Their local practices and customs would be different, and which may result into some kind of a disputes because of the local understanding being different for each bank. So they have given certain standards. Of course, within the limited time we have today, we cannot go through the standards per se, but these are some of the important standards which are applicable to the forex environment. And of course, as we go along, we can always keep on learning about this area also. Now, the most important thing when we talk about forex in relation to FEMA, whether the transaction which our client has done or is proposing to do, whether it is a capital account transaction or a current account transaction. Why it is so important for us to understand in relation to especially FEMA is because the basic rule is the thumb rule, I can say, is that all current account transactions are allowed unless until there is a specific prohibition in this. There may be cap up to the amount up to which you can do it, but of course, most of the current account transactions are allowed. But capital account transactions, the thumb rule is the reverse. Most of the transactions are not allowed unless specifically there is a provision which allows you to do it. So any transaction, when we test it in terms of the FEMA guidelines, the first thing which we need to test is whether it is a current account transaction or a capital account transaction. The definition I have given, it is from basically the FEMA Act only. So basically, the capital account transaction is a transaction which alters the assets or liability, including contingent liabilities outside India of a person resident in India, or assets or liability in India of a person resident outside India, and includes certain specific transactions. So basically, what affects your basically the balance sheet would fall into a capital account transaction. So you getting foreign, basically investment from outside India from a non-resident or a foreign company is a capital account transaction. You investing outside India, you're buying shares outside India, you're acquiring a property outside India, would be a capital account transactions. And the current account transactions, you can basically uh, deduce from there. So the very important, the first aspect, whenever I speak about FEMA, I tell people that the first thing which you have to see is the transaction which you are going to do or which the client has already done, whether it falls within the current account transaction or the capital account transactions. Okay. Now, when we look at the current account transactions, so one would be basically the trade-related transactions like imports and exports. We'll talk about it a little later. But there would be a lot of transactions which are clean outward remittances. So when we look at clean outward remittances in case of current account, we have foreign exchange management, current account transactions rules. It gives you three lists: prohibited transaction, schedule 1, transaction which require prior approval, schedule 2, and permitted transactions subject to a ceiling, basically schedule 3. So schedule 3 is the residual list. Whatever does not fall in schedule 1 and schedule 2 would fall in schedule 3. So there cannot be an exhaustive list for schedule 3. We'll see what is a schedule 1 transaction. So these are the transactions which are prohibited. Now you're doing an audit, you see any of these transactions in the transaction done by your client. It is a red mark. It is a prohibition. There is no approval. Even the RBI is not authorized to give approval for these transactions. It would specifically be required to be reported as a regulatory breach by the auditor. So we need to be careful about it. Then transactions which require a prior approval from some ministry or a department. Okay, so on the left hand side, you see the purpose of remittance. On the right hand side, you see the ministry or the department from which the approval is required. Okay, so your company may be a TV channel. Okay, and they may be hiring transponders on the satellites for beaming those news, etc. Then it requires a dual approval from Ministry of Information and Broadcasting and Ministry of Communication and Information Technology. So unless until this approval is there, it is something which was not allowed under the law and would require a specific comment in the audit report from the auditor. So these things we should be aware of when we look at a transaction of a client. Then this is Schedule 3. Of course, as I told you, there cannot be an exhaustive list of Schedule 3 transactions. I have only given you some examples of it along with the limit which are specified therein. So, of course, as we go along, we verify the transaction done by our clients. We need to be careful that these transactions are something which could have been done, but whether the limit was maintained or not. Because what happens sometimes is that certain clients would have multiple banking facilities. They would be dealing with multiple banks. So single bank may not be aware that there is a breach in the limit. The limit has been breached. But as an auditor, when you verify a transaction, you may have to see that the transaction limit has been breached. So you need to be more careful than, of course, the banks in certain cases because they would not be able to track out whether the same transaction might have been done with multiple banks. Okay, so this becomes important. So knowledge, of course, the regulatory knowledge is very important, and we should be aware of before we attempt to do the audit of the forex transactions. Then we have a scheme called as a liberalized remittance scheme. Uh, Maybe if 5 years down the line, if I used to speak about liberalized remittance scheme, maybe 50-60% of these CAs would have only responded by saying that they know about LRS. Now, of course, due to the TDS provisions which has come in the Income Tax Act, where TDS is applicable for any remittances outside India under LRS, a lot of people are actually aware of the LRS provisions. So just to complete that in a very, very short time, this is only applicable to a resident individual. So non-individuals are not covered by the LRS provisions. Okay, the limit is USD 2,50,000 per financial year. So this limit is per person, including a minor. So minor would have a separate limit to the say their parents basically, and it is for a financial year starting off with 1st April, ending with 31st March. You have got a limit of USD 2,50,000. You are allowed to do a current account transaction. You are allowed to do a capital account transaction. You are allowed to do a combination of both, right? The total amount is USD 2,50,000. In case you have exhausted the limit before the expiry of 31st March and you require more, there would be a requirement to take a specific approval from the Reserve Bank of India, a prior approval. And in case you have not used the complete limit, right? On 31st March, the limit would become zero. So there is no carryover. You cannot say that because I have not used the limit, please allow me to carry over the limit. There is no carryover. Next year, again, it will become USD 2,50,000. What you can do in that, a lot of current account transactions you can do like private visit to any country. Like a lot of people go for a leisure travel. So that is covered by private visit, except Nepal and Bhutan. So again, this is an important area. In case your client is dealing with Nepal and Bhutan, please remember under the FEMA regulations, you are neither allowed to take foreign exchange for the purpose of travel to Nepal or Bhutan, even for imports from Nepal and Bhutan. Even if you are making an investment into Nepal or Bhutan, in Nepal, you cannot take foreign exchange for the purpose of investment into Nepal. For Bhutan, you are allowed to take foreign exchange, or you can invest into Indian rupees also while making investment into Bhutan. Okay, so this is again an area because I've seen I have clients who are basically dealing with a lot of activities with in relation to Nepal. So the money flow happens in a very different mode, right? So it is more like an RTGS transaction which happens. So you should be aware of it. And you can do gifts and donation. You can basically, if you're going abroad for employment, you can take the money in case you're going for emigration. You're sending money for close maintenance of close relatives abroad. Close relative, the definition being the definition of a relative given under the Companies Act 2013 then travel for business, conference, specialized training, meeting expenses for medical expenses abroad, attendant to a patient going abroad for medical treatment, studies abroad, and any other current account transaction, which of course does not fall in Schedule 1, which is the prohibited list, and Schedule 2, which requires a prior approval. So if any transaction is in the prohibited list, you cannot do it under any regulation. Okay. And if it requires a prior approval, you will have to seek that prior. Okay. So this is there. Then we have seen transactions. There is a limitation in terms of what you cannot do under LRS, this limit. So you are allowed to basically buy shares and securities outside India. You are allowed to even buy property outside India under this because capital count transactions are allowed. But what we have seen here is that sometimes people do transaction in foreign currency abroad. This is not allowed. And I've seen cases where there are advertisements telling people that you can invest, you can trade in foreign exchange abroad, which is not allowed, right? Secondly, we have seen transaction where people have done futures and options. So basically, these forward commitments outside India. So buying share securities are allowed under LRS scheme, but margin calls to overseas exchange, overseas counterparty, is something which is not permissible. Then buying property outside India. So buying property is allowed, but you cannot take a loan outside India. Say you want to buy a property for say 10 lakh US dollars. You are only allowed to commit 2,50,000. So you cannot take a loan outside India and take a property. So that requires a specific approval under the. So there are different regulations under FEMA for a loan taken outside India by a resident. Okay. So sometimes what we are seeing that people are aware of the LRS guidelines, but they are not aware of the pitfalls associated with it. So we need to be careful when we see any such transaction in case of a crime. We need to see whether it is strictly within the regulatory area and there is no breach of the regulatory guidelines. Again, because I've been practicing in the area of FEMA for many years now more than 15 years now. What I've seen is over the years, the RBI has become very, very strict about the compliance part. Earlier, a lot of compliances, when people used to miss out, the RBI used to leave it with a warning letter. Now they have brought out with the concept of LSR, late submission fee. They have come out with penalties. They have come out with detailed guidelines. So there's a hardening of stance on the part of the RBI that they do not want to see any breach of any guidelines. And in case there is any breach, howsoever small, howsoever technical, they would invite some kind of either a penalty from RBI or some kind of a late submission fee or some kind of a panel action would be invoked by the RBI. So the forex transaction, the compliance of the forex guidelines becomes more critical for the companies. I've seen cases. Let me share with you where say somebody a non-resident invested into a property into India, agriculture property. They didn't realize at that point of time that this was something which was not specifically, this is something which is prohibited under the FDI guideline. There is a specific regulation which prohibits a non-resident to acquire agriculture property in India. Now, when they sold the property and wanted to take the money back, the RBI heavily penalized whether whatever profit they made, they forfeited the complete amount from the NRI. So the penalty was running into crores of rupees. So sometimes a technical breach, he may not have been aware, but the guidelines are very strict here. And it may invite a very strong panel action from the Reserve Bank of India. So we need to be very careful while guiding our client by verifying the transactions that there is no regulatory breach of the guidelines. Okay. Then in case you are doing remittances to country identified under FATF. FATF is Financial Action Task Force. So it's actually a multilateral body, which is basically looking at the KYC, the AML compliance at the level of countries, at the level of territories, at the level of jurisdictions. So it gives certain lists. One of the lists is non-cooperative countries, the countries which are not cooperating with the international system to ensure that their financial system is not misused for any money laundering or terrorist financing activities. So we should be aware which are the countries which are covered by it, where there are some kind of prohibitions, there are some kind of sanctions. Because in case you are doing any such transactions with those countries, your client may have done any such transactions, they may be penalized. The money may not come in, so there might be a serious financial loss which they might arise to the client, or they may not be able to do they not may be able to complete the financial commitment which they have undertaken. So you should be aware of the FATF, what is the latest list. I'll show you the list also of the FATF, what is the latest list as of now. And then there are certain entities which RBI prescribes, which have a significant risk of committing acts of terrorism. So you cannot actually deal with those entities also. You cannot send money to them. You cannot deal with them. So you need to be very careful about these transactions. Okay. Then uh, okay, we can. So now second is this is where we do a clean out of remittance. Now I've seen cases where somebody called me up telling me, sir, my client, uh, uh, there is a raid, income tax raid, which has happened in case of search in case of my client. There is some unutilized foreign currency which was lying with him. He went for a foreign trip. There was money which was lying with him, some unutilized foreign currency which was lying with him from that earlier trip which he has undertaken. So what are the regulations? Whether, say, you have taken some money for currency for the purpose of travel outside India, you have completed that travel, whether you can retain that money, for how much period you can retain that money, right? So you should be aware of those provisions also. Suppose is showing in the balance sheet an amount which is exceeding the regulatory limit, you need to be careful. You should be able to tell them that this is a breach of the regulatory guidelines. Okay. So what is the guidelines there? The guidelines says that in case you have acquired forex for a specific purpose and you have not utilized that forex for that purpose, you can use for any other eligible purpose. There is no approval which is required. In case you have taken forex for the purpose of travel outside India, and you have traveled outside India, you have come back to India, you have got 180 days to decide what to do with the unspent foreign currency lying with you. So when you come back to India, there would be stamp on the passport. From that date, you have got 180 days to decide what to do with the unspent foreign currency. Suppose you have 3,000 US dollars lying with you, which remains unspent. Now, what is the regulation? The regulation says 180 days, either use or surrender. Okay, simple. In case it further allows that you may retain up to USD 2000, and this is 2000 per, not per trip, it is per individual, okay, per person. They may retain for an indefinite period of time. And this 2000 does not include foreign currency funds. So in case the client is holding more than that, you need to advise them that which may be a breach of the regulatory guidelines. Okay. And it may be appearing in your balance sheet, you may be certifying, and then you may be saying in the audit report that there is no apparent breach of the regulatory guidelines. You have to report on any breach of the regulatory guidelines, it becomes an audit qualification. Whereas on the face of the on the face of the balance sheet itself, it is clear that there is a breach of the regulatory guidelines. So you need to be careful about it. Then, of course, we can leave the definition here. Then there are some special accounts under FEMA, NRE, NRO, FCNR, SNRR, RFC, RFCD, EFC, Diamond Dollar account. We'll not touch on every one of them because that is not the area which we are discussing. In case of NRE, what is very important is in case you are getting funds from an NRE account, especially say if the funds are being received from an NRE account, you're issuing shares to that person. Now, what I've seen again is, though it gets covered under FDI guidelines again, now somebody approached us, uh, they had a huge business, they had a company, multiple companies. One of their sons was a non-resident. He was living abroad, working there only. He had an account in India, NRE account. They issued shares to him, taking money from the NRE account. Okay. We told them this is a violation of the FDI guidelines. There should be because once you take money from an NRE account from a non-resident and issue shares to them, it becomes part of the foreign direct investment guidelines. It is covered by that. So we need to check for the compliance of the foreign direct investment guidelines. Now they were not aware. They thought they have taken money from their son. The account is in India only. It is not the money has come from outside India. So these kind of issues might arise. And the bank may not be able to trace out that transaction also. Because the money has flown from an Indian account to an Indian account, the bank may not be able to point out that you require to do some compliances, right? And you may have done inadvertently some violations of the FEMA guidelines, which would invite again some kind of a regulatory breach, would invite some kind of a panel action from the side of the regulator. We have seen such kind of cases. So transaction with NRE accounts, okay, would becomes very important. Then again, similarly in case of FCNR account. So FCNR again is foreign currency non-resident deposit account. So any money flowing from an FCNR account, NRE and FCNR practically been on the similar footing, could invite that kind of a consideration. Then special non-resident rupee account. In case you have a foreign client who is doing some project in India, they would require some account in India for the purpose of putting it through the credits and debit of that project. They do not want to open a company in India. They do not want to open a liaison office or branch office in India, right? So they can open a SNRR account, right? So there are certain regulations which are applicable to SNRR account. The maximum period for which you can maintain a SNRR account is 7 years, right? Except in a few cases where the period can be extended, but otherwise the maximum time frame is 7 years. The balance in the SNR account is eligible for repatriation of payment of the due tax. So payment of due tax would require a CA to get involved with the payment of the due tax in such cases. So in case you have a client who has opened a SNR account, you should be aware of the guidelines which are applicable to such an account. And then you should ensure the compliance of those guidelines, because otherwise there would be a breach of the regulatory guidelines, which would then again invite some kind of a panel action from the side of the Reserve Bank of India. Okay. Then we have EFC account. EFC account is exchange earners foreign currency account. So any person who is basically into exports and imports can open a current account which is denominated in foreign currency. It is a non-interest bearing current account. 100% of your exchange earning can be credited to the account. It can be used for making payments outside India. So there is no need for conversion because the account is in foreign currency itself. Now, there is a very important guideline which are attached to it. It says that whatever credits have come in one calendar month, say from 1st July to 31st July, whatever credits have come by 31st August, the next calendar month, and either you have to utilize it or convert it into your normal rupee account balance and transfer it to a normal current or savings account of yours. So you cannot hold on to the balance in this EFC account for an unlimited period of time, except for any forward commitment. So suppose you go to the bank, tell them that after 2 months I have to make a payment for an import transaction, you give them that evidence. So the bank would earmark that much amount for the payment of that import transaction. Rest of the amount we will have to either convert or utilize. Now, suppose your client has a EFC account, the money is lying there. There may be cases the bank is following up with the customer, telling them to convert. The customer is not doing it. So he's breaching the regulatory guideline. So as an auditor, we should be aware of it. We should be able to tell the client that this is a breach of the regulatory guidelines. You need to be careful about it. You need to ensure the compliance of these guidelines. Okay. Then we have resident foreign currency account. Then diamond dollar account similarly is like your EFC account is meant for firms and companies dealing with purchase sale of rough or cut diamonds, precious metal jewelry with track record of at least 2 years and average and annual turnover of 3 crores above. So the similar guidelines like in EFC, whatever credits have been received in one calendar month, by the end of the next calendar month, you have to either utilize or convert, applies to diamond dollar account also. So you should be aware of these guidelines. Now, then we have accounts like FCRA account. Now, FCRA account would be more important when it comes to companies which are basically into charitable, Section 8 companies basically, or basically trust societies, etc., which are into charitable kind of activities. But I've seen cases where somebody has approached us asking us about whether FCRA guidelines would apply to them. They were a commercial enterprise, right? So have seen an example where somebody during the COVID times received certain oxygen concentrators from some foreign suppliers of theirs as a gift to be supplied to hospitals in India. So they received those oxygen concentrators, they supplied it to various hospitals in India free of cost, right? So they were concerned whether FCRA guidelines would apply to them. What is FCRA? Foreign Contribution Regulation Act. It is a separate act to the FEMA guidelines. Okay, it is not FEMA basically, it is a separate act, 2010, right? So it is basically applicable to foreign contributions which you have received. What is a foreign contribution? They have defined it. So basically, if you see the explanation 3 in the last paragraph, it would basically give you an idea. It says amount received by way of fee, cost in lieu of goods or services rendered by such person in the ordinary course of business, trade or commerce, whether within India or outside India, is not foreign contribution. So if I try to analyze explanation 3, so if you're receiving any money in terms of fee, cost in lieu of goods or services rendered by you, then it would not amount to a foreign contribution. Or if I try to reverse the definition, so anything which I'm receiving where there is no consideration on my part in terms of goods or services would amount to a foreign contribution. In fact, it has come from a foreign source, right? So I'm trying to give you the definition in a short manner. So it would amount to a foreign contribution. In case you have received any foreign contribution, then it has a certain compliance. Receiving the foreign contribution itself requires first a registration or a prior permission from the central government, which is Ministry of Home Affairs. And only after that permission or registration, you can obtain those foreign contributions. I've seen cases, sir, where people have received foreign contribution. They're not even aware that they have received foreign contribution. Because again, what happens is, I'll give you an example, very interesting example, if you understand. Suppose there is a person who is a foreign citizen. Say Mr. X, who is a foreign citizen, he is a citizen of US. He is working in India. He has taken up a job. He is working in India. Now, as per the definition given under FEMA, he'll become resident. If he has taken up a job in India after complying with certain time limits, he'll become a resident in India. His account, which would be opened, would be a normal savings account, right? Now he gives a donation to, say, some school or some charitable trust. Money may be flowing from a savings account of an individual who is a foreign citizen, traveling to a savings or a current account of a trust, a school, or any such institution. It would amount to foreign contribution, right? And this trust would require to obtain a registration or a prior permission from the MHA before receiving such fund, and would have to open a FCRA account and take that money only in that FCRA account. And any utilization of that funds, there is a return which needs to be filed to the MHA, right? Now, I've seen cases where people are not even aware that they have violated the rules. So in case you are auditing any such trust or institution, it becomes very important. I'll tell you a very interesting example. We were auditing one of our very big trusts, temple trusts of North. Now, because there is a foreign contribution, now we have a money box in any mandir you go, any religious trust you go. There would be, so they used to receive not only Indian rupees, foreign currency also in that money box on a daily basis. Now the question arose whether that foreign currency amounts to a FCRA fund, because the money is foreign currency. Now we told them that if the foreign currency, say suppose I'm a resident, I come, I go directly to that mandir. I put that foreign currency which may be lying in my pocket inside that money box. Because it is coming from a resident, it would not amount to FCRA. But even the Indian rupees coming from a foreign citizen would amount to FCRA. So these kind of issues would also arise. So we need to understand the provisions of the law. There will be certain cases where we need to see what are the clarifications which has been issued by the relevant authority in such cases. So these are the certain areas where I've seen a lot of violations happening, where people are not aware that they have violated the rules. And as an auditor, we are not able to bring it out through our report. We are not also, as an advisor, able to guide them properly. So it becomes a problem for the auditors. Okay, so we need to be careful about this. Then when we come to basically the area of trade transactions, imports and exports. So here again, the first thing which we need to understand is that how trade transaction actually flows. Let's try to understand that for somebody who may be not aware of it. So let's take an example to just understand this area. So suppose there is Mr. X in India who's basically importing goods from Y from say US, right? Y sends the goods to X. X gets certain documents. We'll understand what are those documents. Would go to the bank, ask them to make payment to Y. Now, how does that payment actually happen? Okay, so the payment would happen through a system called an NOSCO and a WOSCO. What is a NOSCO account? So now SBA requires on the request of X to make payment to Y in US. So what they does is they open an account with another bank in US. Say they open an account with American Express Bank. Okay, so they will open an account with American Express Bank. It would be open in the name of SBI, and it would be funded by SBI. And then whenever such a request would come for the payment to be done for an import transaction, they would ask that bank, the American Express Bank, to make the payment on behalf of X to Y, and they would send the instructions to the American Express Bank to make the payment. So this is an Nostro account, right? So like we open an account with any bank in India, bank is opening an account with another bank. We may do a reconciliation on a yearly basis if somebody may be a lethargic like I am, or somebody may do a reconciliation on a weekly basis or a monthly basis. But the bank does a reconciliation on a daily basis, and we have seen cases where bank have lost loads of money for non-reconciliation or wrong reconciliation. Okay, so Nostro account becomes very important. Now, second point is how does bank inform the other bank, American Express, that the payment needs to be done? So they can do a WhatsApp also. Somebody might say that what is so difficult about it? They can do a WhatsApp also. Now, WhatsApp is free. So it requires a certain kind of a framework because the information should be complete, the message should be authenticated. Nobody should be able to change the message once it is done. So so we have a mechanism called as Swift. Swift is basically a society who has provided a framework. So anybody who wants to become part of Swift has to pay a membership fee to the society, and then only they can send some those messages basically. So Swift becomes important. This is one of these frauds which happen in case of bank where in case of Indian Overseas Bank, one of their branch manager transferred around 302 crore rupees in 16 different installments to a company formed in HK, Color Lab HK Limited. Then he resigned and left the bank before the bank realized that they have taken around 302 crore rupees of the bank along with them. So this is non-reconciliation of the Nostro account. So this is something which is important, especially if you are bank auditor and you're auditing a branch which is having a Nostro account. So every branch does not hold a Nostro account. Only a category A branch of a bank holds a Nostro account. Okay. Then uh, we have Incoterms. Now, Incoterms becomes very important, especially in case of foreign trade. Now, what is Incoterms? Generally, people may not recognize Incoterms per se, but the full form is International Commercial Terms. People would recognize what is an FOB basically. So FOB is one kind of an Incoterm. What is so important about it, Incoterms, is basically it is defining the rights and liability of a buyer and seller in a transaction. So any trade transaction which happens, say goods are being purchased from Y from US by X in India. So the value of the goods, X has to pay to Y. Y would deliver the goods. But the transaction involves a lot of other elements also. Who will pay for the local transport from the Y's factory to the say the goods are being shipped. So to the port, who will get the goods cleared, who will get it loaded onto the ship, who will pay the shipping freight, who will pay for the insurance, who will pay for the unloading charges at the destination, who will get the goods cleared, who will pay for the custom duty, who will deliver the goods at the godown of the X. So these are some of the costs. And there is another element of risk. Who will bear what risk at what point of time? So these Incoterms actually help us in determining the usage of these Incoterms. helps us in determining what are the costs and risks associated with the transaction. So as an auditor, you should be aware of, right? That when is the supply of the goods complete? When the we generally say when the risk gets transferred. So the Incoterm would basically help you in determining what is the costs which you are going to bear and what are the risks which the client is bearing in any given transaction. So you should be aware of the Incoterms. You should be aware of the type of Incoterms. You should be aware what could happen in case the Incoterm changes. Okay. Then, of course, we have OFAC. OFAC is actually a US law, but because of the control of US on the financial transactions, most of the financial transactions get routed to some kind of financial institution based out of US. They have actually tried to enforce that across the world. So it involves basically a list of countries and individuals and entities which are called as SDN, specially designated nations. So any bank which does a transaction first does a check on the OFAC whether any such remittance is being done outside India falls within the list of OFAC which is prohibited, and they would not do such a transaction. So sometimes what we have seen is that the banks are not, the individuals are not aware. They get into financial commitments, and when they approach the bank for doing a transaction, the bank refuses to do a transaction because that entity or the individual or the country is hit by OFAC. Okay. Similarly, is in case of FATF, which I told you, these are the countries, the first list of countries, FATF countries, which require an additional due diligence by the banks. Okay. So we should be careful that in case our client is dealing with any of those countries, they are more risky countries. There are chances of money laundering, there are chances of terrorist financing. So the bank would also be very reluctant or very careful while doing such transactions. So as a auditor of such an entity which may be dealing with any of those countries, we also need to ensure that we do our proper due diligence in case of transaction done with these kind of countries. Then comprehensive sanction countries, no transactions are allowed. You cannot do transaction with these countries. It involves Iran, Syria, North Korea, and Cuba, right? And there are certain areas of Ukraine which has been specifically barred, which from doing any transactions. Okay, Iran, of course, uh, we are able to do transactions in Indian rupees. So there's a special mechanism which is there in case of transactions with Iran, but otherwise transactions are not allowed at all. Okay, even if the goods are emanating from these countries, and the payment may be going to some other country, the bank would refuse to do the transaction. So we need to be careful. Then countries having specific sectoral sanctions, it involves Burma, Myanmar, or Russia or Venezuela. So in case of Russian entities, there are a lot of entities which are under sanctions. There are a lot of ports from where the goods cannot be purchased. There are lots of items or goods or which are prohibited for which payment would not be done. So I've seen recently somebody approached us that they actually did a financial commitment for a purchase of goods. The goods arrived, but the bank is now refusing to make the payment because it has the come from a prohibited port actually, where there was a sanctioned port basically. The bank has a problem there. So the client is now facing the problem. So we should be aware of these guidelines basically, right? Then when it comes to import and export, one very, very important aspect which I've seen most of the auditors not checking or not being aware of, there has been a digitalization which RBI has also done for trade transactions. So we have a system of EDPMS, Export Data Processing and Monitoring System, which uh, uh, which is there, and then we have a system of IDPMS, Import Data Processing and Monitoring System. So there are two systems, and there's a report which gets generated from the system. That report the client cannot generate directly; it has to be generated to the banker. Okay, please, in any audit which you are doing, where the client has done any import transaction or export transaction, please ask the client to provide you an updated list of EDPMS and IDPMS. Take it from the bank. You will be surprised that there are a lot of entries which are outstanding. please try and understand. There may be regulatory breaches there. There may be issues which would actually trouble you a lot later. Even now, when we are approaching RBI in a lot of cases for seeking some approvals, so some deviation we have done, we need RBI approval for it. In case of a commercial organization, they are asking that please provide us the list of outstanding entries in IDPMS and EDPMS. Please provide us the roadmap as to how you will settle those entries. So these are you can understand the kind of importance RBI is putting to those entries. What can be the entries? You may have made a payment for advance for import, but you have not imported the goods. You may have done an import, but you have not submitted the import evidence to the bank. You may have done an import, you have not made the payment. So these kind of transactions, you may do some entry in your books of account. You may write off also in your books of account. But it is writing off in the books of account is not the complete closure because the aspect is covered under FEMA. You may have to require RBI approval for it. And without that RBI approval, that writing off in the books of account may not serve the purpose. So I've seen the auditors not being aware of it, not asking for IDPMS, EDPMS reports, and getting into later on trouble with these kind of transactions. So we'll not get into the detail of what is an import transaction, how that import actually happens, but please be very careful about IDPMS, EDPMS transactions and the system which has been developed by the RBI in this regard. Okay. Then another area which this is IDPMS. It was made effective from 2017 and EDPMS was made effective from 2014. So already 10 years for EDPMS. So a lot of data is there and even in cases we have seen that for clients which are not frequently doing import-export transactions. So they may have done a transaction on a very occasional basis. We have seen outstanding entries in the IDPMS, EDPMS for which they may be receiving notices from the bank, but which they may not be disclosing to you as an auditor, and which is very important for you to verify. Okay. Then another area which I have seen, frankly, concerns is one is the trade credits. So trade credits basically comprises of two areas: buyer's credit and supplier's credit. So buyer's credit, of course, because of the change in the international rate scenarios, a lot of buyer's credit transactions are not happening from foreign banks. Now they are happening through the IFSC setup in Gujarat. A lot of transactions are happening from there. But of course, buyer's credit I've seen is one of the areas which is very risky as far as compliance is concerned. What is the problem there? So, for somebody who may not be aware of what is the exact modus operandi of how a buyer's credit transaction actually works, so let me explain to you through a chart. So there's an X who's a buyer. He has to make a payment for an import which he may have done from seller Y. He is looking out to get a buyer's credit. So basically, this buyer's credit is financing of an import transaction. Okay, this financing can be either done by a foreign bank or overseas branch of an Indian bank. Okay, so local branch cannot give you buyer's credit. So he approaches, in our example, JP Morgan for extending a buyer's credit to them. Now, there has been this is also one of the very important areas where we have heard a fraud which happened in PNB in case of Nirav Modi. That was the transaction of buyer's credit only. So, what is written here is when that transaction was done. So, after that Nirav Modi scam, there was certain changes which was done by the Reserve Bank of India and the modus operandi of buyer's credit. But the basic way the transaction happens is the same. So in this case, I have given you the Nirav Modi scam transaction, and then I'll explain to you what has changed after the scam. So now, any bank which gives you a financing would generally require some kind of a security, some kind of a credit appraisal for you before they give you any money, right? So in case of buyer's credit, that security for that foreign bank was basically a LOC or LUT, LOC letter of comfort or LUT letter of undertaking, which used to come from an Indian bank. So Indian bank used to basically confirm who basically the foreign bank or the overseas branch of our Indian bank that they would make the payment on the due date along with the interest, irrespective of the fact whether their constituent X makes the payment to them or not. So on the basis of that guarantee, basically the LOC, LUT issued by the Indian bank, the foreign bank used to make the payment. So uh, for the Indian bank, it becomes a kind of a non-fund based limit because they are taking a credit risk, right? They are not giving money per se, but they are taking a credit risk that on the due date, if X does not make the payment to them, they will have to make the payment to JP Morgan. Okay. So in case of Nirav Modi, the scam was basically this Bank of India, if we replace with PNB, they did not have any kind of security. Whether they, what they was claimed was that they were not even aware that these LOC, LUTs were being issued. So how they were not aware? Because these LOCs and LUTs were being issued through the system of SWIFT. So the messages could have been sent without making an entry in the books of account. Was the major risk factor or the major the credit point which came out of it, that this was a lacuna which was left into the system, that you can send messages creating liability for the bank without entering anything in the books of account. So then the bank started actually looking at this from that credit risk perspective and getting it audited also in certain cases, that whatever SWIFT messages have been sent, whether they have been appropriately recorded in the books of account. Okay. So now what would happen in this case is JP Morgan, on the basis of this LOC LUT, would either make the payment directly to the seller by the bank of seller by, or generally what happens is they transfer the money to the Nostro account of Bank of India. And on the basis of this credit entry received in their Nostro account, they would make the payment to seller by. So the loan is taken by X, the buyer, but in the books of X, you will not find any entry for this loan which has been obtained. Okay, there may be some entries for some processing charges which he may have charged to the bank charges, and you are not aware, you have not verified each and every single entry, and you are not aware that they have obtained a buyer's credit transaction. Okay, so what they do is, because there is no entry, they show this seller Y as outstanding in their books of account as a creditor, right? Actually, what has happened is seller Y has been paid, so the creditor should go out, and in its place, there should be a short-term loan which should arrive of JP Morgan. Okay. Why it is so important for us as an auditor to verify? One, it would impact your financial position. Secondly, when you pay interest to JP Morgan, sometimes what I've again seen is sometimes they park it as bank charges rather than showing it as interest. It would require a withholding tax also, right? Because the payment is of interest is being made to a foreign bank, it may require a withholding tax also, which again they may have not done, again requiring you to appropriately take it in your audit. So this is important. Of course, after the Nirav Modi scam, let me also clarify what has changed is that in place of LOC, LUT, now bank issued bank guarantee or standby letter of credit SBLCs for the purpose of obtaining these credit limit for their clients. Okay. So this is one of the very important areas. Similar is in case of a supplier's credit. We'll have to just skip it because we have a very limited time here, right? So this becomes important. Okay, then 15 CAC. Again, this is one of the very, very important areas which I've seen. Incidentally, we audit one of, we have been auditing whether from the last many years, more than 15 years now, very, very huge branches of Forex for banks doing their content audit or internal audits. And what we have seen is this is an area where there's a lot of mistakes happening. This impacts not only somebody who's issuing 15 CB a CA certificate, but they may impact us as the auditor for that firm which has done that remittance outside India on the basis of this 15 CA CB tax. Now, first, the process was completely overhauled in 2013 first and then 2016. Now we have two concepts, 15 CACB and 15 CA is being used for informing, basically online intimation to the income tax department about any remittances which may have been done outside India. And 15 CB is a CA certificate in all, only when you fill 15 CA Part C that you are required to fill a 15 CB. In other cases, it is not so required. What I've seen is a lot of times we have seen clients issuing 15 CA Part D. Part D is where the amount being remitted outside India is not chargeable to tax under the income tax act. They are issuing 15 CA Part D, getting it remitted to the banks. Bank claim because they are not responsible for verifying the technical details of 15 CA CB. They would do the remittance in a lot of cases, and the transaction actually requires a withholding tax, which the client may not have done, and they may have done basically a wrong representation of the whole issue, right? So as an auditor, we need to verify such cases. Then we have seen cases where somebody may have done a payment through a credit card online, but there 15 CACV may not have been required, but the transaction may still be required to get get verified in terms of the withholding tax guidelines. So this becomes very critical. We should also be aware there are 33 types of remittances where 15 CACV is not required. We should be aware that what are those remittances in case that has happened. And import, in case of import payments, 15 CACV is not required as per the CBDT guidelines. However, we'll discuss in the coming slide that there may be cases in case of imports where actually a withholding tax may be required and the client may not have taken done the withholding tax. We'll understand it. Okay. We leave exports. We have done exports. We have already understood. Then there are third-party payments for exports, and this is one of the area where a lot of money laundering has happened in past. Now banks have also become a little strict about it, but you need to also verify it as an auditor. Now, what is the point here is that suppose you have done a import transaction, you have purchased from Y. So you make the payment to Y. If you are making payment to Z and saying it is against payment import done from Y, it is a third party payment. And in case of export, if you have done an export to Y, the payment should come from Y. If it is coming from Z and you claim that the payment is against export done to Y, then it is called as a third party receipt. It has a very, very strict guideline in terms of RBI circular. And the again, that EDPMS, IDPMS becomes important. The client may have adjusted that third party payment against the import or export, but the payment would remain outstanding in the IDPMS, EDPMS because it may not be permitted under the guidelines and would require a specific RBI approval. So you should be aware that that setup which the client may have shown in the books of account may not be right, may not be correct. You may have to show it separately till the point of time that the guidelines are met or the specific approval is taken. Okay, so it becomes very critical, sir. Then we have merchanting trade transaction, another area where RBI has over the years become very, very strict. What is a merchanting trade transaction is basically is say there's a company in Y in US, there's somebody Z in Australia, and we have X in India. Okay, so X is purchasing goods from Y, selling those goods to Z, right? But what happens is the movement happens from Y to Z. So goods do not enter the domestic tariff area of India. It becomes a merchanting trade transaction. Okay. RBI has been very, very concerned with these kind of transactions, have a separate set of guidelines to cater to the merchanting trade transactions. The guidelines are very, very strict, very, very exacting. You need to be aware of these guidelines in case your client is doing those merchanting trade transactions. We have handled cases where the client in the books of account have shown everything is all right. They have received the payment, they have made the payment, they are showing everything is all right. But all the transactions are outstanding in IDPMS and EDPMS because the guidelines were violated. And when we approach RBI, huge penalties were levied because of the violations done in the merchanting trade guidelines. Okay, so as an auditor, the picture which emanates from the financial statement may not be reflecting the correct position as per the regulatory guidelines. Okay, So these are some of the guidelines which are applicable to merchanting trade, like no entry in the domestic tariff area, no change in the state of goods for, except for some specific processing, value addition, etc. Completion of both legs from import to export, both legs within 9 months, foreign exchange outlay within 4 months, so that in case you have made a payment for import and you have to yet realize the payment for export, the gap cannot exceed 4 months. Both the legs, import and export, both should be routed to the same bank, and the original document should be given to the bank. Reasonable profit to the merchant trader is a must. If the payment for export leg comes prior to the import payment, either you park in the EFC account, interest bearing INR account, strictly earmarked for making payment for the respective import leg. So you cannot use that payment for any other purpose. The amount which you have to pay for the import leg has to be strictly earmarked. That money cannot be used, cannot, sir. It can only be parked in an EFC account, or you can park it into FD account also, interest bearing account also. No, there is no problem, but that amount would be earmarked for making that import payment. Okay. This is again something which we have seen a violation happening. And then there is a one-to-one matching of the import transaction which needs to be done. Okay. Then inward remittances, which has come to your client. There would be inward remittance uh, advice which would have been given by the bank to the client. Please, for large transactions and which may not be trade transactions specifically, please look at the advices. Please look at the reasons why the money has come. I'll tell you a very again interesting case which we found out. We were auditing one of the banks where there was an account for one of very famous, basically godman, basically, and he was receiving a lot of remittances from outside India, and he was declaring those remittances as advisory services. So he was advising them on spiritual and religious matter, and he was receiving payments against them. But the person who was sending that money was showing that as donation, that I'm donating to the godman. When we pointed out that issue, we said what the person declaring, the person who is receiving the money is declaring. I can understand in a one or two case that the receiver may have misdeclared. But in all such cases, if this is happening, then there is a problem. So that person, we said, he needs to get covered by the FCRA guideline, which we discussed a little way back, that the money is coming as donation, not as in terms of basically the business receipts. So it is covered by the FCRA guideline. And when we reported that issue, the matter got escalated very soon, and the bank was forced to freeze the account, all the funds of the account also, immediate basis. And then the client was advised to go for the FCRA approval before the funds can be released. So not only the bank did not allow further funds to be received, the funds which were already lying into the account were also freezed. So the inward remittances, other than especially for trade transaction, needs to be specifically verified in case of your clients from the advice given by the banks. Okay. Then there can be issues in relation to export credits. So we have guidelines in relation to that. Maybe we can take it later if time permits. Okay. Then LCs, we should be aware of the terms of the LC, how an LC actually works. What are the guidelines in terms of LC? What is the usance LC? What is the site LC? We should be aware of it. What is the liability of the customer in case an LC is outstanding? And then we have standby letter of credits again, which is a relatively newer concern, but which is now being regularly used when we do audits for banks. We see a regular use of SPLC in a lot of transactions, so we should be aware of it. Then capital account transactions again is something which is very, very critical. And RBI has become very, very strict about comprising under the capital account transaction, basically comprising of three areas. Foreign direct investment, where a non-resident or a foreign company is investing into India. Overseas direct investment, Indian resident Indian companies investing outside India. And external commercial bonds, basically where loans, etc., are obtained from outside India, either from a foreign equity holder or from financial institutions outside India. So So RBI has become very, very strict. They view even a small technical uh, violation, they would either take it very seriously, and they would either penalize or ask for a payment of a late submission fee, or they would ask you to come for compounding of the offense. So you need to be very careful where a client has entered into any capital account transactions specifically. And secondly, what I've seen again is that a lot of times people approach us that they have done a capital account transaction. They were not informed that they need to do certain compliances. They did, so they wanted us to do the compliances, and they do not have the requisite documents with them. So you should be aware that the requisite documents are lying with them. I'll give you certain examples also as we go along in this area. So in case of in case of FDI, the guidelines come in basically from FAN non-debt instrument rules 2019. So these are the rules which are applicable in case you are doing an FDI transaction. What is basically FDI, if you understand? It is investment into an unlisted Indian company or in 10% or more of the post-issue paid-up equity capital on a fully diluted basis of a listed Indian company. So in a listed Indian company, if it is more than 10% on a fully diluted basis, only then it would amount to foreign direct investment. Otherwise, it is considered basically what we call as a foreign portfolio investment. Okay. Then in case of LLP, there is a FDI which is possible in case of LLP. Then it can be either capital contribution or acquisition transfer of profit share. Okay. Then downstream investment. This is another area where I've seen a lot of violations happening. What is a downstream investment? So I'll give you by an example what is a downstream investment. So there is a non-resident investor, right? It has invested into an Indian company. It becomes a foreign direct investment. Okay. That company, the first level company, is owned and controlled by a resident. Owned and controlled both, right? So the rules define what is ownership and what is control. Then that's first level company invests into the share capital of another Indian company. So there is a parent A, right? Indian company, say IC1. It has invested into another company, IC2. IC2 may have invested into IC3, right? So it is basically a downstream investment. In case the IC1 has a foreign direct investment, there is an indirect foreign direct investment in IC2 and IC3 also. This is called as a downstream investment. Now, every case where there is a such a arrangement would not amount to downstream investment as per the rules. So what they say is that if the ownership and control is with resident, then it is not a downstream investment of the IC1. In case ownership or control is with non-resident of IC1, any further investment they may have done in IC2, IC3 would also be an indirect FDI. Now, what happens is, recently we are handling a case where somebody had a foreign direct investment with them. They formed another company in India, which was, say, practically wholly owned by them only. Now, because that IC1, the parent company, had foreign direct investment, and either the ownership or control was with a non-resident, that IC2 also required, when they invested into that IC2, there was a requirement of filing form with the Reserve Bank of India declaring it as an indirect foreign direct investment, which they did not do. And now suddenly, due to certain factors, there were due diligence which happened in their case, and suddenly they pointed out that this investment has not been done. There is a violation of the foreign direct investment rules. Now, I've seen a lot of even professionals not being aware of such an indirect FDI. So we need to be very careful. Okay. So this is it. And we have, of course, forms which are applicable. So in case of indirect investment, you have, if you see the last third form from below, reporting of downstream investment form detail. So it becomes important. Okay. Then of course there was a circular which came during the COVID times, which said that any investment into an Indian company from a country which shares land border with India or where the beneficial owner of an investment into India is situated in or is a citizen of any such country can only invest under government rules. So prior approval is required. There is a proper procedure how the approval has to be sought from the government. So basically, it was targeted towards Chinese investors, but a lot of countries like Pakistan, Afghanistan, even Nepal, even Burma, for that matter, even Bangladesh would get covered. China, of course, would get covered. China, then Hong Kong would get covered because it is under Chinese control. So basically, these all countries get hit by these regulations. Sometimes what we have seen is some Chinese individuals may have invested into a company in Singapore. That Singapore company may have invested into India. That also is okay. So you need to be careful now. Even if you are forming a company, they it specifically ask in case you are appointing somebody as a director whether he requires a prior approval from the government before he can be appointed as a director, which is basically the germane of the issue is arising from this press note which has come from the result from the central government. Okay. So this is there, you should be aware of it. Then, of course, in case somebody is opening a Liaison office, branch office, there are specific guidelines which exist in such cases. Then, in case of investment by residents abroad, uh, we have guidelines which have come. So recently, 2022, August 2022, the guidelines have completely been overhauled. A lot of problems have started arising because of that overhaul also. So we should be aware of the guidelines. One of the very important area which arose this year specifically was where so there is an annual performance report every year. In case you have made an investment outside India, you have to file the performance report of that foreign enterprise with RBI every year. You have to do by 31st December. So you have to submit APR to AD every year or not before 31st December of each JDWS based upon audited annual accounts. Now, this again has created a lot of problem because in a lot of cases, what has happened is the host country does not require an audit. It does not mandate an audit. But now, earlier before 2022, it was not mandatory that the audited accounts are to be submitted in case the host country regulation does not require an audit. Now it has been made mandatory. So a lot of queries are there from chartered accountants whether they can sign, whether they can audit these foreign enterprises. Okay, and you need to be careful. I think what I can suggest is please refer to SA 800, audit under special considerations, and see the compliance of that before you do any such audit. Because I've seen a lot of people just writing that they have done audit under the guidelines of, say, Singapore law or some other foreign country law, which may not be permissible, because that host country regulation may not be permitting you to do the audit itself. So if you declare that on the face of the audit report that you have done the audit under the guidelines given at that host country, you may find yourself in a suit. Okay, so please be careful. Look at SA 800 before you sign any such audit. Okay, so this is there. Then of course you have to submit. Again, this is a violation which we are seeing very frequently. A lot of people are not aware that in case they have foreign direct investment or overseas direct investment, they have to file a return called as foreign liabilities and assets FLA by 15th of July every year. It is a mandatory return. Earlier, people were not aware. RBI was also not taking any strict action. But now, suddenly, they have started charging late submission fees for not submission of the returns. In case you have not submitted the return, they are not allowing a lot of foreign transactions to happen. So if you approach a bank, ask them to do ODI remittance, they would ask for the FLA return. If you have not filed the return, they will not do the transaction itself. So please check whether your client has done the reporting under FLA if it is so required. Okay. Then I have seen cases where the client may have gone outside India. This happens especially in case of neighboring countries like Dubai, etc. He has taken certain money with him in form of currency. That money he gives to some local advisor to form a company, and on that basis, the shares are issued to that individual. This is not permitted. Acquiring shares through payment made in foreign currency is not a permissible method. But this is again a violation which we see on a very, very frequent basis. Okay. So there are a lot of issues. Then direct investment in step down subsidies. So suppose you have a company in Singapore, SG1. That company has another step down subsidiary, say in China, SG2. You have made an investment directly in SG2. This is something which is not permitted and may require a specific approval. In case you have done it, you would be considered as having violated the rules and penal provisions would follow. Then earlier, what we have also seen people giving loans to their foreign subsidiaries or bullion subsidiaries or JVs, and they did not used to charge interest sometimes, or they used to charge interest on a very, very low rate of interest. Now, of course, it gets covered by the transfer pricing regulation also. And in the new revised guidelines, RBI specifically said that these interests on loan are required to be given on a arm's length basis. So very important. Okay. Then, of course, external commercial borrowings, again, similarly, there are points that what we have seen specifically in case of external commercial borrowings is that you cannot draw down, you cannot bring money in India unless until you have a loan registration number. And that loan registration number is given after you file the form to the Reserve Bank of India, the Form EC. What we have seen in a lot of cases is that, especially where the money is coming from your foreign equity holder, people have brought money, misdeclaring as, say, for some other purpose, and ultimately it was for loan. And then suddenly, after 5 years, they suddenly realize that the money has to be sent back, and now the bank is refusing to send back the money, and the money is outstanding in the books of account. And the bank is asking for an auditor certificate. Auditor is finding it difficult to issue a certificate because they have never declared this as a violation of the ECB guidelines. We have seen such kind of instances also. So unless until in case you are taking any loan, you have to check the ECB guidelines. Even if the money is coming from your own parent abroad, then also it requires a compliance of the ECB guidelines. And in case the money is lying from many years, sometimes what I've seen is people misdeclare this as export advance, bring the money. There's no intention to do an export. Please check as an auditor whether there is an intention to do an export, whether they are in the similar field. Sometimes the entity itself is not in the field which requires that the parent would require an export from them. Or the entity itself, the parent is supplying goods to them. So they do not require any export from the Indian entity, but they have declared this as an export advance and brought the money, and which is actually in form of a loan. So that may be a misdeclaration would involve a panel provision under the TFMR guidelines. So please be very careful as an auditor. Okay, then we'll just give some important. How much time we have? I think 10 to 15 minutes. Okay, let me just try and wrap it up for you. Then, of course, when it comes to accounting, 2-3 issues which just I want to point out. Accounting standard 11 would be applicable to foreign exchange transaction. Then we have in the AS 21 and in AS 109 in relation to financial instruments. Now, what I've seen in AS 11, basically, what in a lot of times we have seen is people do not take a confirmation from the bank as to the forward commitments which your bank, which your client may have basically undertaken. So he may have taken forward covers. There is no entry in the books of account. Okay, but it not only the entry is required to be done, the AS11 even requires not only that that you revalue your transactions from the date of recording to the date of actual making the payment, and that you revalue the monetary items. Forward commitments also needs to be recognized, and any gain or loss needs to be amortized as an expense or income over the life of the contract. So this is something which is I've seen regularly that people do not take any confirmation. It may not be available to you from the books of account. Please take a confirmation of the bank as to how many forward commitments are outstanding for the client. See whether the entries have been properly accounted in the books of account, whether any gain or loss has been properly accounted as per the guidelines of given in the accounting standard. So that is important. And of course, the income tax guideline in relation to Section 43A, Redwood Rule 115, this becomes important. Rule 26. Rule 26 is very important in case of 15 CA also. When you convert that invoice value into INR for the purpose of deduction of tax at source, what is the rate which you are going to apply? Because the TDS value would change in case you change the rate. So what is the rate? Please do look at Rule 26 given under the income tax rule. It defines what is the rate. So it talks about buying TT rate, and then it talks about the band from which you have to take. It is basically the SBI which you have to see. So that becomes very important because in case you are taking a wrong rate, the TDS might not be deducted correctly, and in that case, you may have inadvertently violated the guidelines. Okay. So that it becomes important. Then income computation and disclosures under ICDS are there. Okay. Then transfer pricing regulation, of course. So a very, very important area, very, very technical area. I feel a lot of us do not want to get into that area, but at least we should have an understanding because it could impact your audit, especially where the companies have associated enterprises as defined under the relevant provisions. What are the transactions which are covered in it? What are the transactions which are allowed? How the that arrival of that arm's length basis has to be done? So we should be at least, even if we are not doing TP study ourselves, but we should be at least aware that there are guidelines which needs to be complied. What are the guidelines for how that arm's length basis is to be checked? Then this is again an area where I've seen when I speak to a lot of professionals, I've seen a lot of professionals not being aware. So let me ask by starting with a question. Suppose you are an importer in India, you are buying goods from somebody from outside India. It is purchase of goods only. Whether you are required to do withholding tax on that value of goods which you have purchased from that person outside India. Can there be any circumstance in which it may require a withholding tax? So a lot of people would generally say no. If it is purchase of goods, it does not require a withholding tax, right? Please, I would encourage you to go through section 9(1) of the Income Tax Act. There is an explanation 2A which was added in financial year 21-22. Already we are 2 years uh, from that date, right? It talks about a concept of significant economic presence, SEP. And it says significant economic presence shall constitute a business connection. It would be deemed to be considered as a business connection. And they have defined what is a significant economic presence. And the definition says non-resident with transaction of goods, services, or property, including provision of download of data or software in India to any person in India for a value more than rupees 2 crore in a financial year deemed to be a business connection, sir. Only the limit is only 2 crores. And this limit is not applicable to you. Say Mr. X is importing goods from 10 buyers, 10 sellers from abroad. This limit of 2 crores is not on Mr. X. They are on those sellers abroad. Say they may be selling to 10 sellers in India, 10 buyers in India. So the total limit they are selling to India, if it exceeds 2 crore, they would deem to have a business connection. And in case they have deemed to have a business connection, there's some portion of the income, profit attributable to these activities shall be deemed to accrue or arise in. This is a very, very serious provision, sir. It has already there in the rule book from the last 2 years. Please check whether your client is actually taking care of these provisions or not, sir. So pure import of goods might require a withholding tax, and in case you do not do a TDS in case of a resident, you are required to actually do a 30% uh, disallowance, which you are required to do. In case you have not done a TDS in case of a non-resident, 100% disallowance has to be done of the expenditure. Okay, so would have very, very serious implications for you. Then OIDAR, this has become a headache for most of us as an auditors also. And there's so much confusion, there's so much changes in the regulatory landscape which is happening. So basically it covers areas like internet advertising. Uh, just to share with you, on I think 2nd August or 3rd August, nearly 1 lakh notices has been issued by GST for non-compliance of GST under reverse charge for online advertising. So they have obtained data from some online advertiser like Facebook, etc., and they have issued notices to people to actually tell and whether they have actually paid tax under reverse charge or not. Nearly 1 lakh notices have been issued. Okay. So this is the kind of issues which are rising. So cloud services, e-books, movies, music, software, digital data storage, and online gaming. So a lot of times payments are being done through credit cards. The bank is not taking 15 CSDB. You may not be aware. The payments may not be of very, very huge sums, but it may require compliance in terms of GST also, in terms of withholding tax also, in terms of equalization also, right? So it comes to then withholding tax, of course, we should be aware of it. We have talked about it. Then equalization levy. This again an area where sometimes I've seen people not being complying with this area. Started off in 2016 with 6% charge on basically online advertisement. Now, in 2020, they added 2% for e-commerce operators, especially e-commerce operators where they are providing services, they are providing digital platforms. There is a serious issue. They may be getting covered both by equalization levy as well as by uh, the withholding tax regulations. Of course, a relief has come that with effect from 1st August 2024, this equalization levy in case of 2% for e-commerce operator has been done away with. But last year, sir, for which you may be auditing this time, the equalization levy was applicable, sir, whether you have complied with it. And there is a disallowance of that expenditure in case the payment has not been done. Okay. Then reverse charge under GST, we have already spoken about it in case of this. Then corporate guarantees to foreign subsidiaries may amount to a requirement of doing a payment of GST. Then temporary transfer permitting use of enjoyment of intellectual property rights. So you may have taken a basically a license for using our intellectual property mark from your parent, or you may have transferred that right to your foreign entity. It may require a GST payment. Okay. So they may not have charged a consideration, but it may still require a payment from GST. Then you have to obtain a legal identity identifier code in case you have done a cross-border transaction of 50 crores and more with effect from October 1, 2020. So you should be aware of the how LEI is to be taken. And yearly there has to be a renewal of LEI that also you should be, the client must be doing. Okay. And of course, audit, I think the Hegde covered it quite well. So I'll not get in the area of the audit per se, but the I think the most important is, which I want to again point out, please, in case your client is dealing even into imports and exports, please obtain EDPMS report, IDPMS report, bank certificates for balance confirmation, bank certificate for any buyer supplies credit which may be outstanding, for which entry may not have been done in the books of account, then bank certificate for outstanding forward covers, derivative contracts, then confirmation for any BG invoked, LC default which the client may not be disclosing to you, and confirmation from any other points which may be relevant from the client's point of view. So this is a very important aspect where we actually generally are happy taking that bank statement from the client, but that may not be the correct position reflecting, because you may now with online system, the problem is you can obtain generate a report on say 31st March morning also. It will show the ending date at 31st March only, right? But they may have been transaction which may be done after generating of that report itself, isn't it? Or sometimes what happens is even the bank does a validated debit to the client. So please obtain that balance confirmation from the banks. That is the correct way of actually checking the closing ledger balances which should be there. And then of course these areas, unless until you specifically ask the bank to provide, you will not be able to verify in case of paper. And of course the audit report requires you to assess that appropriate evidence, arrive at an audit conclusion, and then drafting audit reports become important finalization and duty generation. So I think I've just managed to cover it within the time allocated to me. So thank you so much everyone for the patient hearing. Any questions which are there? I'm not sure whether there are any questions. We can take it.
Thank you so much, sir, for sharing your valuable insights. I think we have some questions. So first question is like, what are some critical disclosures related to forex transactions that, as an auditor, we should verify in the financials of Indian companies or banks?
So banks, I would not be able to cover here because banks have a very different way of disclosure of, and the reporting is very different. But in case of Indian companies, of course, I have told you about a lot of areas which needs to be looked at. Of course, AS 11 and Ind AS also requires you to basically disclose that differences in foreign exchange which has been taken into books of account. There is a specific reporting which is required for it. And there may be other areas also depending upon case to case. Like in case of downstream investment, there is a specific reporting requirement which is there, which comes from FEMA. So that needs to be done. So depending on case to case, there would be a lot of requirements of disclosure and anything which is critical. And there is no specific reporting requirement, but which is critical to be disclosed for the usage of the user of the financial statement. Then also, of course, it is always advisable to disclose that information in the notes to accounts, the appropriate ways.
Okay, thank you, sir. So next question is, how we as an auditor can ensure that professional skepticism remain unbiased, especially like when we are dealing with long-standing clients.
I think I made a reference to it while speaking about it, that I mean, even in case of long-standing clients, obviously trust, but then verify all the documents. And then, I mean, whenever you are looking at evidence, whichever is there, once if the evidence, say one evidence is and the other evidence doesn't seem to tally, or there seems to be something fishy, then obviously you'll have to probe a little more and go into deeper audit processes, adopt extra audit processes. But it is not, as I said, one doesn't have to act as a bloodhound. But at the same time, just because there is a client which is a long-standing client does not mean that we abandon our skepticism cap, I think is the message that everyone gives us.
Okay, thank you, sir. I would request Ajay to continue with next set of questions. Over to you, Ajay.
Yeah, sure, Mansi. So I have also received some of the questions. So the very first question is that if the resident wants to transfer the listed company's shares to his non-resident relative, so whether prior approval of the Reserve Bank of India would be required?
Ajay, see whether a prior approval would be required cannot be given without understanding the complete facts. But generally, if that investment per se does not require an approval, the transfer itself would also not require an approval. But depending upon the client, so if it is on actual sales basis, so you will have to seek an evaluation from the valuer. And in case you are actually transferring the shares as on the value given by the valuer or more than that, then it may not require an approval per se. Of course, there would be a filing which has to be done, a regulatory filing which has to be done, but the approval may not be required. But if it is in form of a gift or you are transferring it at a value less than the fair market value determined by the valuer, then of course it would require a prior approval. So it would depend upon case to case.
Thank you. So I have also one question to discuss, more question. The assessee who has now become the resident, but when he was a non-resident, um, there was another account in the another country in which the salary was credited and it is still parked in such account for many years. So the question is that what disclosures are required for the same?
Okay, so per se, one thing is that you are allowed in case that money which was credited to that account came from your resources which you have generated outside India when you were a non-resident. You can continue to hold on to that account. There is no restriction as far as FEMA goes. Secondly, because you have become a resident, what is required to be done is because you have to done a compliance with the black money law also, and under the Income Tax Act also, the form which you file with the Income Tax Department, requires you to disclose any foreign assets which you hold, including bank accounts also. So in that case, you have to disclose that bank account in the return which you have filed. And recently, again, in the last 2, 3 years, we have seen a lot of notices being received by individuals specifically, where they have foreign bank accounts, which they have opened for some reason. There might be some money lying into that account, or may there not be much of the resources. There are in certain cases, we have seen a lot of resources also lying there, but the disclosure was not made. And they have received notices from the income tax department inquiring about all the details. So investigation teams are basically sending notices and inquiring for all such cases. So we need to be careful about these things.
Thank you so much, sir.
I think there is another question. NCLT admitted the petition filed by supplier under Insolvency and Bankruptcy Code 2016, which was stayed by High Court, educating authority appointed resolution professional to carry the functions mentioned in the IBC. Whether these things should be reported with qualified opinion.
See, whether a qualification is required, I'm not sure, because qualification would be require you to state that the financial statement are not correctly disclosing something. In case you want to draw an attention to something, you can always draw your attention to, there can be key audit matters for that matter, or there can be other ways of disclosure of that facts. As far as just because it is under IBC does not, to my mind, requires qualification in the main audit. That is what I feel. Of course, the disclosure is required to be done, and the fact about solvency, because we talk about it in terms of going concern. In case that going concern principle is violated, a specific disclosure is required in the audit report also. And in that case, if the auditor feels that the satisfactory evidence is not available to satisfy the concept of going concern, the basic assumption of going concern, then of course the appropriate disclosure needs to be done in the audit report.
Okay, I think that answers all the question. Thank you so much, sir. I would request Anil sir to deliver the vote of thanks.
Thank you so much, madam. Thank you so much, sir, for such a wonderful deliberation. You have covered all the aspects relating to the key considerations in audit of forex transactions, and sir has already enlightened all of us regarding the professional skepticism. So, on behalf of AASP of ICI, I extend my heartiest thanks towards both the learned speaker and especially to our keynote speaker, CA NC Hegde sir, past Central Council member of ICI, for his valuable time and enlighten all of us regarding the professional skepticism, as well as C. Lokesh Gupta ji regarding these forex transactions, what audit considerations are required in forex transactions. So thank you so much on behalf of AASP of ICI. I also extend both the moderators for wonderfully moderating this today's webinar. I also extend thanks to all the participants of today's webinar. Thank you so much. Thank you so much, everyone. Good evening.
Thanks, everyone.
Thank you.